Welcome to a new topic on private company valuation, where we'll learn the differences in valuation approaches between private and public companies. In this first lesson, we'll study the key factors that distinguish private and public company valuation, and also the reasons for performing private company valuations. Let's jump right in. Private firms simply refer to firms that are not publicly listed. Such firms can be sole proprietorships, privately held corporations, or previously public companies that have been taken private. The characteristics that distinguish private from public companies can be delineated into company-specific and stock-specific factors. Company-specific factors include the following: the stage of life cycle that the company is in. Private companies are typically less mature than public firms. Sometimes, however, private firms are mature firms or bankrupt firms near liquidation. Obviously, the valuation analysis will vary with the life cycle stage of the firm. The firm size. Private firms typically have less capital, fewer assets, and fewer employees than public firms, and, as such, can be riskier. Accordingly, private firms are often valued using greater risk premiums and greater required returns compared to public firms. A lack of access to public equity markets can constrain a private firm's growth. However, the regulatory burden associated with issuing public equity may outweigh the benefits of greater access to funds. On the other hand, the regulatory framework that public firms have to adhere to also results in better quality of financial information and disclosures to the public. In contrast, private firms are not required to make timely, in-depth financial disclosures. A potential investor in a private firm will have less information, which leads to greater uncertainty, higher risk, and reduces private firm valuations. However, note that in the case of fairness options for private firm valuations, the analyst typically has complete access to the firm's financial statements and business records. The quality and depth of management. Smaller private firms may not be able to attract as many qualified applicants as public firms. This may reduce the depth of management, slow growth, and increase risk at private firms. The management shareholder overlap. In most private firms, management has a substantial ownership position. In this case, external shareholders may have less influence. However, this may also mean that the management may be able to take a longer-term perspective without having to focus on short-term growth. In contrast, shareholders of public companies often focus on short-term measures of performance, such as the level and consistency of quarterly earnings. In such cases, management of public firms may take a shorter-term view compared to private firms. And lastly, taxes. Since most managers of private firms are majority owners of the business, they may be more concerned about the impact of income tax. As such, they may place higher priority to the reduction of reported taxable income. Next, let us look at the stock-specific distinguishing factors between private and public firms. Firstly, liquidity. Shares in private companies typically have fewer potential owners and are therefore less liquid than publicly traded shares. A liquidity discount is often applied in valuing privately held shares to compensate investors for the lack of liquidity in the stock. Besides, shares issued by some private firms may have restrictions on marketability. There may be agreements that prevent shareholders from selling, reducing the marketability of shares. And lastly, concentration of control. The control of private firms is usually concentrated in the hands of a few shareholders, which may lead to actions that benefit the controlling owners at the expense of minority shareholders. In summary, these are the company-specific and stock-specific factors that distinguish private firms from public firms, and these have bearing on the valuation of private firms versus public firms. Company-specific factors can have positive or negative effects on private company valuations, whereas stock-specific factors are usually a negative. Compared to public companies, private companies have greater range of differences, so the appropriate discount rates and methods for valuing them vary widely as well. The reasons for valuing private firms can also be varied, broadly classified as transaction-related valuations, compliance-related valuations, and litigation-related valuations. Transaction-related valuations are necessary when selling or financing a firm. For firms in the early and development stage, venture capital investors are an important source of financing. Due to the uncertainty of future cash flows, valuations are usually subject to negotiation and are somewhat informal. To reduce risk to the venture capital investor, the capital is often provided in rounds after the achievement of specific benchmarks known as milestones. Valuation is very important when a firm wants to go public. Investment banks often perform IPO valuations using the values of similar public firms as a benchmark. In mergers and acquisitions, the valuation of the target firm is very important to the acquirer, as the acquirer does not want to overpay. Valuations are usually performed by both parties and are subject to negotiation. For firms in bankruptcy, accurate valuation can help determine whether the firm should be liquidated or reorganized. If it is determined that the firm can continue as a going concern, accurate valuation is important in its restructuring. Compliance-related valuations are performed for legal or regulatory reasons. One primary focus is in the area of financial reporting. Goodwill impairment tests for public companies is one common application. Essentially, components of public companies are valued using private company valuation techniques. The reporting of stock-based compensation also requires accurate valuation. Valuation is also used for tax reporting. At the firm level, transfer pricing, property taxes, and corporate restructuring may necessitate valuations. At the individual level, estate and gift tax issues may necessitate valuations. Litigation-related valuations may be required for shareholder suits, damage claims, lost profit claims, or divorce settlements. Because the valuation methods for transactions, compliance, and litigation are often quite different, most appraisers specialize in a single area. Transaction-related valuations are usually performed by investment bankers, compliance-related valuations by those with accounting or tax knowledge, and litigation-related valuations by those comfortable with a legal setting and specific jurisdictions. And that concludes this first lesson on private company valuation. Still a lot to cover, so see you at the next lesson where we'll learn the definitions